If you're a Canadian investor on the hunt for some solid monthly income, you've probably seen a couple of new ETFs pop up on your radar. Ninepoint ECHI and Harvest HHIC. They both come with some pretty eye-catching yields, but what are they all about? Well, in this case study, we're going to break it all down.
Okay, before we jump in, just a quick note on where our info comes from. Everything you're about to see is based on our own research and data that we've pulled directly from the Ninepoint and Harvest Company websites.
And as you know, it's really important to remember that this is all for informational and educational purposes. We're just exploring these ideas together, so this is definitely not financial advice.
Everyone's situation is unique, right? So it's always a great idea to chat with a qualified financial or tax advisor to get guidance that's tailored just for you before making any moves.
All right, with that out of the way, let's get to the question that's probably on a lot of our minds. How can we get a bit more monthly income from our Canadian investments? These new ETFs claim to have an answer, so let's see how they do it.
So here's what we've got planned. We'll start by introducing the two ETFs. Then we'll look at how they're built, because they're actually pretty similar. After that, we'll dive into the key differences, check out their early performance, and then we'll spotlight their strategies. And to wrap it all up, I'll share how we're thinking about using them in our own portfolio for 2026.
Okay, let's properly meet the two funds at the heart of our case study today. We've got the Harvest High Income Shares ETF, which goes by the ticker HHIC, and we have the Ninepoint Enhanced Canadian High Income Shares ETF, or ECHI. Both of them are pretty new to the scene, having launched in the second half of 2025.
So, as you can see, HHIC got started in August of 2025, and right now it's yielding around 13.9%. ECHI came along just a month later, in September, and its current yield is sitting around 15.4%. Now, it's super important to remember, these yields aren't set in stone. They're going to move around with the ETF's price and its payout.
Now, here's what's really interesting. When you pop the hood on these two, you find out they're built on a very similar framework. Before we get into what makes them different, it's really crucial to see just how much they actually have in common.
Yeah, take a look at this. Both ECHIC and HIHIC are what you call a fund of funds. So they basically hold a bunch of other ETFs. They both use a covered call strategy to generate that nice income stream, and they both use a little bit of leverage, about 25%, to help with cash flow. And of course, they're good to go for accounts like TFSAs and RRSPs. They pay out every month, and they're both considered medium risk with a focus on big-name Canadian companies.
Okay, so if their basic design is so similar, where do they start to go their separate ways? What's the real distinction here? Well, it all comes down to some subtle but really important differences in what they hold and what they charge. Let's dig in.
Here's a look at the top holdings for each fund. On the left, you've got HHIC from Harvest, and on the right is ECHI from Ninepoint. You'll probably notice a lot of the same names. You know, the big Canadian banks, telecoms, Shopify. But the real story isn't just what they own, it's how much of each they own. Those weightings are where these two really start to show their unique personalities. And this table just lays it out perfectly. Look at Harvest HHIC. It has a really heavy weighting in financials, about 35%, plus another 15% in telecom. Now, compare that to Ninepoint's ECHI. It's much more focused on energy, commodities, and gold. That's almost half of the whole portfolio. And you can see they both have a very similar, pretty big stake in our Canadian tech giant, Shopify. There's also a little difference in the fees. Ninepoint's ECHI is a bit lower at 0.29%, and they've even got this little promo running with zero fees until the end of February 2026. Harvest's HHIC is at 0.4%, which, is still very reasonable for this kind of fund. So how did all of this translate into actual performance? Well, we've got about 4 months of data to look at, from September through the end of December 2025. I know, it's a really short window, but it can still give us a few clues. Just looking at the price of the units themselves, ECHI got off to a really strong start. It went up about 15%. HIC also did well with a 9% gain, which was right in line with another popular fund, HDIV, and pretty close to the main Canadian benchmark, XIU. And that extra juice from ECHI, you can pretty much chalk that up to its heavy holdings in gold and commodities, which had a fantastic run in late 2025. But hey, for income funds, price is only half the story, isn't it? Once you add in those monthly distributions to get the total return, the numbers get even better. EHI's estimated total return was up around 21%, and HIC was a very respectable 15.5%. Both of them did quite a bit better than the benchmark during this little stretch.
And that brings us to what I think is the most crucial point of all.
This early performance suggests that these aren't yield traps, funds that pay a high yield but the price just keeps dropping. These funds actually managed to pay out that high income while their price either held steady or went up. That's exactly what you want to see.
Okay, let's connect these numbers back to the strategy. The performance we just saw wasn't random. It was a direct result of those sector choices we looked at. It's really a story about blending stability with a bit of a cyclical element.
So you can think of HIC's strategy as being built on a bedrock of stability. With more than a third of its money in Canadian banks and another big piece in telecoms, it's really anchored in sectors that have a long history of being pretty reliable for Canadian investors.
HHIC, on the other hand, brings in a slightly different flavor. It leans more into sectors that tend to follow the ups and downs of the economy. That bigger exposure to energy, gold, and commodities gives it the potential for really strong runs when those sectors are hot, just like we saw. But it also means it's probably going to be a little more volatile than HHIC.
So, with all that said, how might we actually use these ETFs in an income portfolio for 2026? Well, for us, we don't really see it as an either-or decision. We actually think they can work together as really nice complementary pieces.
Our approach is pretty straightforward. First, we plan to keep building our core position in HIC. We see it as the anchor of the portfolio, providing that stable, predictable income from the banks and telecoms. Then, step 2 is to start gradually adding some ECHIs as a complementary piece. The thinking here is that ECHIs can act as a bit of a performance booster when commodities and energy are doing well, without adding a ton of extra risk to the overall portfolio. It's all about blending stability with opportunity, and then of course you just monitor both and adjust your allocation over time.
And that really brings us to the final thought here. This case study isn't just about picking the quote-unquote better ETF. It's about a bigger question we all face as investors. So I'm curious, how do you think about balancing those roles of stability and cyclical opportunity in your own portfolio?
We would honestly love to hear your thoughts, so please post any questions or comments you have down below. And if you found this case study useful and you're interested in things like financial independence, passive income, and early retirement, maybe even nomadic life design, we'd love for you to subscribe. We share a full update on our own portfolio around the 20th of every single month, walking through all our moves. Thanks so much for your time today, and we'll see you in the next one.